Good morning, good afternoon and good evening to all the Aussie expats that are joining on today's call. Hope you're having a great day. It dawned on me the other day that we're almost halfway through 2023, which is quite scary. So if you haven't realised it, it's happening quickly. And obviously how I come to that summation is the fact that 30 June is approaching very rapidly. So a bit of a housekeeping call to say, heads up folks, 30 June is coming quickly. In light of that, we'll actually be running a webinar early June with Ben Turner, who's the Managing Director of Expat Tax, our tax division, and we'll be doing some end of financial year tax tips. So we'll be setting out those details shortly. Everyone's sort of piling in now, which is great to see everyone. Thank you very much for your attendance. And just a bit of housekeeping. First of all, can anyone just confirm that they can see our screen? You'll obviously see two little boxes with Mitch and myself, who's the better looking duo of the two of us today. But can you just let us know in the questions box that you can see the screens, please? Yep, fantastic. Thanks, Andrew. Okay, fantastic. Thank you, Paul, as well, and Marie. Oh, still loading here, Marie. Okay, I'll talk slowly. So everyone's starting to really pile in now. So I'll just give them a couple more minutes. Interesting. We ran this webinar as a seminar last week in Dubai and Abu Dhabi, and the feedback, we always get great feedback from these events, and we always like to give it a lot of value as possible. But I think the underlying tone is certainly a case of what was not said as opposed to what was said in this very interesting environment we're in right now. So Mitch and I are going to run through today, address some of the key points, provide a bit of a narrative behind the numbers that we're talking about, and then also to give you guys a bit of an update. So I think we'll get the show on the road there, Mitch. And before I jump any further, I just want to introduce Mitchell Kelsey, who's our financial planner based out of our Australian office, and he's a specialist in the Asia-Pac, so Asia and Americas region. G'day, Mitch.
G'day, Brett. Good to be here.
Yeah, thanks, mate. Thanks for joining us. So there's a lot to go through. There's a lot. There's not a lot. It's a strange sort of budget. It's when it's a budget when they want to do a lot, but they can't do a lot because it's going to sort of put a rocket under inflation and all those sort of key considerations. So let's get the show on the road for the folks out there. Also, too, we'll be emailing out a copy of these slides as well, too. So if you do miss something, don't be too worried. Disclaimers. Anything that we talk about, there's always a disclaimer that associates with this. So essentially what all that boils down to is do not take any of this information as personal or personal advice. It should be treated as information or entertainment purposes only. And if you do need to get personal advice, please reach out to a licensed specialist like Atlas. As I'm based in Dubai, we're dual regulated, and we have ASIC on one side and the DFSA on the other side. So this is my local disclaimer. So shout out to Sam, our compliance manager. She's keeps us on the straight and narrow here. So I've got to show you this one, and essentially it shows that we are licensed in the DIFC to operate and provide financial advice. Okay, so next one we got who is Atlas? Essentially, Atlas Wealth Group is a organisation of groups that really is the overarching goal is to be the ultimate service provider to Australian expats. We don't have a convoluted operational model. By that I mean opaque structures in terms of selling products, buy this property, do all these sort of things. We're a services business. We don't sell property, we don't sell product, we don't do anything of that. So all we are is a fiduciary firm, and our goal is to provide what we call unconflicted advice. So that unconflicted advice means that we don't receive commissions, we don't receive brown paper bags for any kickbacks for recommendations. We're only paid by one person, that's the client. Regulated by ASIC, ATO on the tax side, as well as the DFSA here in Dubai. We work with clients in over 45 countries, and all the people that you meet in a professional capacity with Atlas are degree qualified in that category of work that you're engaging them to do. Here's a bit of a snapshot of what we do. So Atlas Wealth Group is Atlas Mortgages, Atlas Wealth Management, and Atlas Tax. So you think about the full gamut of financial services that Australian expats require when they're overseas. That's what we do. We don't do it on a part-time basis. All we do is deal with these sort of matters on a daily basis and every 5 minutes. So we're match fit for any of the real tough and tricky questions we get. Had a call this morning with a client moving from Toowoomba back to Saudi, and the advice that the accountant in Toowoomba, I'm sure is a great guy and does domestic tax very well, was blatantly wrong. So our job is to really communicate and inform Australian expats out there. This guy, I'm sure, is a great guy and had no intention of providing incorrect advice. But if you're not operating that space on a daily basis, it always seeks to be getting a second opinion if you think that's incorrect. So today we're going to talk about a bit of a summary on the budget, run through from a Treasury and the government point of view on the economy, tax, superannuation, HECS and health debt. That's what Mitch will be covering, as well as property. And then I'll run through and provide a bit of a market update on the currency, equity and property markets, and then obviously throwing it open to the all-important Q&As at the end. So without further ado, I'm going to hand it over to my colleague Mitch, who is going to kick us off on the summary of the budget.
Thanks for that, Brett, and welcome everyone to today's webinar. So as we know, last Tuesday, the 9th of May, saw Treasurer Jim Chalmers hand down his second budget since Labor were elected into power in May last year. And I mean, in our view, the budget was a measured and balanced response to the challenge of supporting households in an environment of relatively high inflation and government debt. And I'll just point out as well, like, important reminder, these are the announcements that we'll go through today. They're just announcements at this stage, and they do still require, the implementation that they need to still go through the Senate. And so they can be updated in the future. They could be updated into the future as well. Next slide, please, Brett. So in terms of some of the challenges that the government faced with this year's budget, so looking to aligning the fiscal policy with monetary policy. I mean, monetary policy, which is I guess the RBA's blunt tool, is it has been doing a lot of the heavy lifting to curb inflation over the last 12 months, and there's definitely been calls for the government to do more to curb this inflation. Definitely, addressing the cost of living crisis in Australia is a big challenge, and with inflation currently running at 7%, it's definitely very high. And another big challenge, for the government was not to undo the last 12 months of work by the RBA, and definitely the government had to be super careful to, I guess, strike a balance between aiding in the cost of living and not fueling inflation. And there's definitely concerns about this, a structural deficit remaining, and the government was limited in its ability to act on curbing inflation in increasing the cost of living. So while this financial year is expected to produce a surplus, there does still remain, it is expected that the budget will return to deficits over the next couple of years as well. Next slide, please, Brett. So who are the beneficiaries? Definitely small businesses were a beneficiary again this year. Renters, not ordinary renters per se, but those that were eligible for rent assist here in Australia. Social welfare recipients as well, so pensioners, job seekers, and single parents as well. Next slide, please, Brett. And then let's take a look at some of the headline government numbers or the forecasts here. So essentially, the government is projecting a fiscal surplus of 4.2 billion this financial year, which is fantastic, and it's the first surplus in fact in over 15 years. So since the financial year of 08, and Treasury forecasts they're showing Treasury forecasts the economy is expected to slow over the coming 2 years. And in terms of inflation is expected to decline from 6% it's expected to be 6% by the end of this financial year, and slowing to 3.25% by the end of next financial year. In terms of unemployment rate is forecast to rise from 3.5%, so the historic low unemployment rate that we have right now, 3.5%. That's expected to increase to 4.25% by the end of next financial year, and 4.5% in June 2025. I mean, just sort of honing in on inflation there, we do believe, this government projection of inflation, the government's expectation, of inflation declining to 3.25% by the end of next financial year is very much, I guess, a little bit optimistic. And I think, with inflation still very hot at 7%, it's going to take it's going to be difficult to sort of get it down to that target rate there. And yeah, next slide, please, Brett. And then looking at the, I guess, the economy as measured by gross domestic product, so GDP or real GDP, so accounting for inflation, it's expected to slow down into next financial year. So it's currently 3.25%, expected to slow to 1.5% next financial year. Really, as you know, the impact of rising interest rates begins to impact on businesses and individuals, and definitely, you know, the gains that the economy benefited from in commodity export prices rising through 2022 will diminish. It's expected that they'll diminish into 2023 and beyond. So you can see there, we've got these are from the budget papers, so you can see it is expected GDP to slow into next year and then return to around that 2 to 3% range into 2026. And with GDP, you know, what will play a massive part in that is the reopening of China and their demand for our commodity prices. So that's going to be a space to watch it as well, because there could be some upside sort of potential for the Australian economy there also. Inflation, so I mean, it's likely that inflation peaked at the end of last year, and the drivers have certainly moved from the good side of inflation to services inflation. And I mean, with this budget being focused predominantly on expenditures in the services sector, you know, for example, aged care, healthcare, training and education, you could really make the argument that this budget is inflationary to some degree. And we've got the CPI figures there as well, so that's you know, CPI is expected to fall over the next 5 years, but you know, with the budgets, sorry, the budgeted expenditures in the areas that I just mentioned, aged care, healthcare, it does really add to that services inflation, which is an issue right now, and it certainly doesn't make the RBA's job any easier at this point in time. Next slide, please, Brett. Just staying on those inflationary pressures, so government's demand on the services sector could put upward pressure on services inflation. So as I just sort of mentioned before, I mean, in the context of a tight labour market, wages support to low-paid workers and aged care workers may contribute to wages inflation. And yeah, again, so sort of doubling up there. So risk, by myself, risk that interest rates will need to be higher and that the fight against inflation will be prolonged. So those inflationary pressures are still very much there, and you know, the RBA is has still got work to do for sure to some extent. Next slide, please, Brad. Drilling down on the wages forecasts, so looking at the next 5 years, so labour market demand is expected to ease somewhat over the forecast horizon, and you know, we've got the unemployment rate there. It's expected to rise from its historical low 3.5%, but remain contained below 4.5% until the 2027 financial year. So we actually did have the latest wages data out today, the wage price index, so capturing the last quarter to March, and so the annual rate, the current annual rate is 3.7%. So it's sort of in line with the government's expectations there. You know, the government expects 3.75% by the end of this financial year. With higher levels of immigration as well, it is expected into next year. It may take longer than expected before we see that unemployment rate begin to rise as well. Sorry, Brad, I jumped the gun there.
Not a problem.
Yep. Next slide, please. Sorry. So moving into some of the budget's measures around tax. So I mean, budget didn't necessarily include, you know, any measures relating to the real sort of structural tax reform, and the government had flagged, you know, previously before this budget that in this term it would focus on the tax policy measures that it took to the federal election, and because of this, you know, I mean, unfortunately, fortunately, you know, whichever way it applies to your personal circumstances. That there was no mention of these proposed changes to the tax residency rule, to the tax residency laws. Sorry, which I know is definitely an area of importance for Australian expats, getting clarity around those tax residency rules when they're arriving in Australia or when they're going to depart Australia. And I think with any budget, it's the proposals that were previously mentioned by the government but not announced in the budget are always paid close attention to, as Brett sort of alluded to in the intro there. And yeah, unfortunately, to be the bearer of the bad news on the tax residency rules, so at this stage it is still the existing 4 tax residency tests and the draft ruling that we received in October 2022, those still act as the most current legislation around the tax residency rules there. There were also no announcements on the proposed changes to the self-managed super fund tax residency rules as well. So in the October budget last year, they had sort of made mention that in terms of the self-managed super fund tax residency rules, they would look to extend the temporary absence rule from 2 years to 5 years. And they were also looking at abolishing the active members test for self-managed super funds as well. So no mention of that in this budget as well, unfortunately. But certainly, as we have any updates on these changes, proposed changes to the tax residency rules, we'll definitely keep everyone updated throughout our socials as well. And I mean, this sort of ties in nicely with this petition that we launched around the budget last year, October last year. And I mean, I believe we had over, correct me if I'm wrong, Brett, we had over 5,000 signatures on this petition looking to urge Parliament to amend the proposed tax residency rules. And we believe that some really good merit towards these consideration or so behind this, there's some really good merit behind our petition, what we believe. So looking at a point system for the factor test, and we also sort of pushing for changing that commencing residency test from 45 days to 90 days. And yeah, as the heading suggests, there, silence is deafening. So ordinarily with these petitions, we can expect a response within 90 days from when they were presented. But you can see here, it was presented on the 6th of October, so it's just ticking over 8 months now without a response. So yeah, a little bit disappointing, but we hope to hear back soon, and sort of something we'll be following up with the relevant department as well.
I think I'll also mention too, Mitch, that the last time Canberra made an official statement was when the Assistant Treasurer was in Singapore, and one of the reporters there asked a question about tax residency and his view on it. He agreed it needs to change. He agreed that the 45 days might be a bit ambitious in terms of on the low side of it, and that they are currently reviewing it. So it's sitting in someone's inbox somewhere, and as soon as we hear any more information from Canberra, we'll certainly let everyone know.
Yeah, definitely. I think he said something to it was in their in-tray or something. So yeah, hopefully we have a response soon.
Doesn't hold out the hope for immediate answers, does it?
No, it definitely does not. Just jump to the next slide, please, Brett. So just on these tax rates. So as with the previous budgets, this year's budget has again not sought to defer the stage 3 tax cuts that were originally announced in 2018. And this was a Labor election promise, and so that there was no explicit mention to defer these stage 3 tax cuts. And just for note, that these are expected to come into effect from 1 July 2025. And certainly a relief that there wasn't any proposed changes to, remove these stage 3 or to introduce these stage 3 tax cuts. So relief to taxpayers. And the government has definitely benefited greatly from this concept referred to as bracket creep. So, it's this concept where, wages have naturally gone up and have forced a lot of taxpayers into these higher tax brackets. So I think taxpayers are definitely, holding out for these proposed changes to come in, and that would have been, outrageous if if the Labor government did look at removing these stage 3 tax cuts. I'll just touch on Medicare as well. So they did propose to change the thresholds for basically the amount of income you can earn before Medicare levy applies. So change that for the thresholds, have changed for singles, families, seniors, and pensioners. So increasing from 1 July 2022 to account for inflation. Next slide, please, Brett. Yes, so the personal income taxation compliance program. So as part of the budget, the government will provide about 90 million to the ATO to extend this personal income taxation compliance program by 2 years. So it was introduced in last year's budget. And this additional funding is really aimed at targeting key areas of non-compliance. So areas such as overclaiming on tax deductions, rental, overclaiming on deductions on rental properties is definitely a big one. And incorrect reporting of income as well is another area that these funds will go towards targeting. Just based on, Brett, you sort of would agree with me as well, based on, a lot of consultations we have with just prospects, a lot of people don't file tax returns once they've headed overseas. That they feel like they don't need to file a tax return, or they'll get it squared away when they head overseas, when they come back. But certainly makes sense to sort of stay up to date on tax returns. Even if you don't have any income to report, just sort of flagging it as return not required. And whilst we're on the topic of tax compliance, this QR code you'll see on this screen here will take you to the I guess the booking page or the meeting page for our specialist expat tax accountant, Ben Turner. So certainly, if anyone listening to today's webinar need any assistance filing your Australian tax return, Ben's definitely your guy. And getting up to date on your tax records, may be daunting to some people. You may have left it a couple of years now. You're sort of putting it on the back burner. It may not be as bad as you think. So just getting that up to date is really important.
Exactly. Everyone's taken the time to attend today's webinar. So 5 seconds, take a screenshot of the QR code. If it's always been in the back of your mind going, I need to catch up, take you straight to Ben's diary, book in a 15-minute complimentary call, run through your situation with Ben. 9 times out of 10, people in their heads have a bigger situation than it actually is, and it's more manageable. You just need to work with the right person. So if you do have outstanding returns and you do need to get on top of them, just hold the phone up to the screen right now. For those on the recording as well too, at your leisure, feel free to book in and have a time with Ben.
Definitely. Just moving into some superannuation measures as well that were announced. So this concessional super tax rate. So it's effectively from 1 July 2025, the tax rate applied to future earnings. So the tax rate applied to earnings for balances over $3 million will be at 30%. And at this stage, it's based on the government's estimates, it's only expected to impact around 80,000 individuals. So only 80,000 individuals have those super balances over 3 million. Currently earnings from superannuation in the accumulation phase are taxed at a concessional tax rate of 15%. It's 0% for those members in pension mode. And this concession will definitely continue for all superannuation accounts on the element of the balance that is below 3 million. I mean, it might sound like a good problem to have. It definitely is, but whilst right now 3 million in super per person may seem like a lot, it's at this stage it's not proposed that this cap be indexed, and so naturally this is going to begin to capture more and more individuals over time. So in 30 years time, $3 million won't be what it was today. So that is something to watch for as well. It's also going to be super sort of problematic, not problematic, sorry, with this 15% tax, it's also applying to unrealized capital gains to some degree as well. So that will be, I guess, problematic when it comes to, you know, a lot of self-managed super funds that might have real assets in their SMSF that, you know, they can't sort of sell part of the business premises, for example, to pay the tax on that, and, you know, if they don't have the cash flow to pay for that, that could definitely be problematic. And there's definitely a lot more to be worked out here before it's legislated, that's for sure.
I think it's also worth highlighting too, that's $3 million per person, not per household as well too. So
yes,
essentially with a husband and wife or a partner, spouse, you're looking at $6 million in total for the household. So we'll on to the next one.
Yes, please, sorry. So payday superannuation. So from 1 July 2026, employers will be required to pay employees super guarantee at the same time as their salary and wages. So we'll require a bit of a redesign of the SG charge and to align with increased payment frequency. And the final, it says that, you know, that based on the budget papers, the final design will be considered as part of the 2025 budget. So essentially, employers right now, you know, with the super guarantee, it's currently 10.5% of an employee's income. It's expected to increase to 11% from next financial year. And right now it's required to be paid at least quarterly. That's sort of the rules. And I think, you know, this change just it does make sense. I think logistically, it's going to allow, I guess, employees to plan better around when their super guarantee contributions are coming, especially if they're looking to, you know, make use of the concessional contribution caps each year. You know, there's plenty of scenarios that I've seen with clients where, you know, they've made a personal contribution looking to make use of or use their maximum concessional contribution cap for a financial year, which for this financial year, for example, is $27,500, and then, you know, their employer's super guarantee contribution has come in and sort of pushed them over the cap. So I think this just makes sense from a, I guess, a logistics, a common sense sort of point of view as well.
Totally
next slide, please. So student help loans. So with help loans, I'll just mention for any, you know, Australian expats on the call today, hopefully by now you're aware that still do need to make repayments on your student help loans. The legislation did change back in 2017, and what's been a real focus last year and also this year, so, you know, is this concept of indexation. So indexation is effectively, you know, interest that's going to apply to your outstanding student help loan. And, you know, for several years prior to 2022, sorry, the indexation applied was between 0 and 2%. Coinciding with record low interest rates. And last year, so essentially this indexation applies on the 1st of June every year. So whatever your outstanding help loan is, the indexation rate that is calculated, it will apply on your outstanding balance, and it's effectively adding to your outstanding loan. So the indexation rate last year was 3.9%. This year, the indexation rate will be 7.1%. So huge rate of indexation that's going to apply to help loans on the 1st of June 2023. And, you know, definitely a good opportunity to, you know, consider paying that down. You know, if you do have, you know, a bit of cash on the side, for example, you could sort of think of it as a bit of an instant saving or an instant return. So, you know, again, 7.1% on your repayment. And
capital guaranteed too.
Exactly, and tax-free. You know, you don't pay tax. It's just a sort of saving there. So likely to be high again next year as well. So the way it's calculated, I won't go into the calculation itself, but it's likely going to be high again next year. So it might be consideration for next year as well. But just make note as well. Still got time before the 1 June indexation applies there.
And just also too, for folks out there to conceptualise what it means, the average super HEX balance, according to the government, is about 23,000. So it translates into a $1,600 jump in your balance in that time. So on 23, it's quite a significant jump too. So, you know, and it does take up to 5 days too for the payment to be processed. So don't do it on the last day of May.
No, that's right. Yeah. I think we just move into some slides here just on property. Just in terms, like right now, the major issues here in Australia in terms of you know, affordability of real estate, but also just renting as well. So in terms of some cost of living measures, there's been some electricity bill relief to eligible households. I believe this does fluctuate from state to state in terms of the amount that you receive. And in addition, some low interest loans as well will be available for energy saving home upgrades. So, you know, battery ready solar power and modern appliances that heat and cool it as well. Just staying on the cost of living measures for households, specifically for property. So this home guarantee scheme, the home guarantee schemes will be expanded to allow for individuals to buy a home. And this includes, there's sort of a couple of variations of this first home guarantee. You've got the first home guarantee scheme, regional first home buyers buyer guarantee, and family home guarantee. And effectively, you know, under these schemes, the federal government acts as a guarantor for a portion of the loan, allowing a house to be purchased with a low deposit and no lender's mortgage insurance. So effectively what really acts as a massive barrier to a lot of first-home buyers is you know, coming up with that 20% deposit, because if you don't have the 20% deposit, you might have, you know, if you don't have the 20% deposit, so you need to pay this lender's mortgage insurance, which is effectively a premium, can be, you know, $15,000, $20,000. And this scheme effectively allows individuals to buy a property with, say, a 5% deposit, and the government will guarantee the difference there. So they'll guarantee 15%, so you've got a 20% deposit there. And with the measures that were introduced, it's sort of expanding this home guarantee scheme. So it's now going to be available to not just a spousal sort of relationship, it can also be eligible to siblings. So if you have a brother, you know, brother and sister, two friends as well. And they've also sort of extended it to not necessarily first-home buyers. So if you haven't actually owned a home for 10 years, you may also be eligible to participate in this scheme. And yeah, that's all I had as part of my part of the presentation today. So with that, I'll now hand over to Brett to do a bit of a market update.
Fantastic, mate. Thanks very much, and good analysis there. And as I guess everyone's surmised now that we're you know, just a bit over 20 minutes in, there wasn't anything too groundbreaking, and to me it's what's occurring underneath, which will be the Mark II, the Mark III updates from Canberra that will really dictate what's going on. And by that I mean, in April the government said they do have an issue with property prices and where it is, and they were convening a meeting either end of April, early May, can't remember which one it was, to discuss possible changes to the taxing of property. So make of that what you will. I've heard 1,000 different hypotheses that, you know, after the second property, you know, the effective tax exemptions or discounts will reduce. Yeah, there's a lot of issues with respect to property affordability, and all the whole message that came through on the budget was always about cost of living and affordability. So they do have a lot of issues. We've also heard rumours about taxing of trusts. So those out there who have trusts, that may change. To me, it's their first real budget after being elected, so they're not going to try and scare the producers out of too many people. But also too, yeah, next year's budget could be the interesting one, because we could have changing of property tax laws, changing of main resident exemptions, all these things that are in the background on the to-do list, but we haven't received a lot of clarity from Canberra. So no doubt it's going to be a busy 12 months. So just also too, folks, I'm going to start running through the market update now. If you've got any questions from what Mitchell's talked about or what I'm about to talk about now, start putting them in the questions box, and I'll whip through this, and then we'll throw it open to the Q&A. So as Mitch said, inflation's a concern. I always find it a bit bizarre because you can have two different government bodies reporting two different numbers. So as Mitch said, Treasury is forecasting inflation to finish at 6% by the end of this financial year. But if you look at the Australian Bureau of Stats, we're currently sitting about 7.2. So one of the two people are lying, and the old saying about, you know, when a politician's lying, they're moving their lips. So I believe the Australian Bureau of Stats more than I believe Albo doing his budget speech. So needless to say, inflation's a massive problem. We have moved from goods across into the services sector. And yeah, what we're seeing, and I'll show some numbers before, you know, very shortly, wage inflation is a big concern, and what has happened with respect to inflation, well, the government has just dumped $20 billion on the whole services sector. So what we saw from from the RBA last week when they released their minutes, so they announced on Tuesday, released their minutes on Thursday, they're potentially modelling interest rates to go to 4.8%. So I know that's a bit of a shock to a lot of people who thought we'd been done with it, but at the end of the day, it comes back to that situation of we're not out of the woods just yet, and that's, you know, sort of what I'll talk about through this through these slides. Wage inflation, that's exactly what Mitch was touching on before. You know, we're sitting at 3.25 right now, and potentially there's a lot more to go. So for me, where we're sitting right now, we're not out of the woods just yet. There's a bit more to play out with this, and that wage inflation is a big concern. Coming back to comparing apples with apples, interest rates. So the left-hand chart there, that's the Australian official cash rate, where we're sitting right now, versus on the right-hand side, we've got the US, the Eurozone, and Japan. So as you can see, we're not at the worst situation, we're not at the best. You know, we're sort of in between, and last week we did see the Bank of England raised their rates as well. ECB's done theirs. Everyone agrees that there's a bit more to go on this. So those people who are calling for a rate reduction anytime soon, I definitely can't see it, and I'll put a case of beer on it, the true Aussie way. We won't see a rate reduction in 2023 calendar year. And I might even be so bold as to say even in the first half of 2024. You know, these inflation is baked into the system. It's baked into a lot, and when it gets into the service sector, it's very hard to control, because obviously goods inflation, you can control that by capacity and consumption. Services a bit, you know, you can't really tell people don't earn as much. So that's a big concern for the Reserve Bank right now. You know, we do meet a lot of folks, James, Mitch, Martin, myself, all the guys, do meet a lot of folks who are sitting on cash at the moment, whether it's under bed or just not doing anything for them. And I thought this chart was a great personification of why you need to do something with your money, whether it's put it into a term deposit, put it into shares, put it into property, whatever it is, you always need to keep your money working, because at the current rate of inflation, essentially you're earning negative 2.2% if you're getting zero yield on that property. So the biggest thing we always talk about with clients is every year that goes by is an opportunity lost. It doesn't mean you have to, you know, sort of bet sheep stations to make a return, but, you know, don't let your money go backwards in this kind of environment. So just be careful of what you're doing on an annual basis, because it can add up over time. So this is a chart that those folks who've joined the webinars before, you know, will see me show it quite a bit, because it really gives you a window into the mums and dads of Oz and how they're going. Obviously, on those top charts there, we look at consumption. We can see consumption is still quite high. That's what the RBA is trying to control by way of raising rates to get people to slow down their spending. But also, too, if you look at that, I think it's blue, Mitch, is it? I'm colourblind, so I always get these colours wrong. But I'm pretty sure it's blue, disposable income. It looks blue. Okay, yeah, we're blind leading the blind. There we go. On that blue line there, you can see disposable income is actually going backwards now. So what that means is after they pay all their bills, they've got nothing left. In actual fact, they can't pay their bills. So they're dipping into savings. They're dipping into credit. And that's where we see this scenario going right now. If you look at the savings ratio, you know, that savings ratio has really come off at a rate of knots. And historically, Aussies aren't good savers. If you look at, especially up to the GFC time in the early 2000s, we were actually running negative, but times were good. You know, and punters were happy not to save. They're happy to spend. But now we've got that scenario where consumption's falling, savings ratios are falling, cost of living is going up, and that's what's causing the greatest concern for the RBA as well. Running through property, let's give you a bit of synopsis on how we see the property market, and you're not going to see any rosy pictures or agendas here. The great thing about being a fiduciary firm is we call it as it is. So we don't care whether clients buy property or not. It makes no financial difference to us. We look at a position on each of these asset classes and take a view based on purely thematics of the investment thesis behind would you invest and would you not invest. So, I think this is a great saying that I thought of immediately when those March property numbers weren't too bad, and people say, oh, the property market's turned, the worst is over. One swallow doesn't make a summer. By that we mean we need to see successive months to get an idea of a pattern. For those out there who are statisticians, 1 month is not statistically significant enough to determine the course of direction, left, right, or straight ahead. So we're really not going to see any true insight until probably, I'd say spring, Aussie spring, so August, September this year. And the reason to say that is there's still more playing out. So when it comes to those rate rises and banks passing through those interest rate increases on mortgages, most banks have only really passed through 8 of the 11 rate rises so far. There is more to come. And by that I mean people are starting to find it tough. And obviously we're not even talking about the mortgage cliff that's occurring with respect to fixed rates reverting to variables. So, for those folks who think, stop raining, the sun's out, there's still got a few more clouds on the horizon. Now, does it mean the world's coming to an end? No, I don't think so. I think very fortunately from a corporate sense, corporates have got very low debt. They're the ones that usually start causing unemployment, and that's when we see recessions start to really get out of control. At the moment, corporate debt levels are very, very low, and we can thank the GFC for that. They learned their lesson, back in 2008, 2009. So that's why we're seeing low unemployment, but companies aren't exactly, I think they're going to start to curtail their hiring practices. So why are we seeing this dichotomy market in the property sector? And it's because supply is tight. If you look at here at building approvals, what's essentially happening here is you've got no new supply coming in, but there's an inventory squeeze that's going on with existing properties. The biggest thing we always talk about with clients is one person can shift a market when there's only one person entering the market. So if you're in a suburb that normally has 20 properties for listing, but there's only 2, and that person who's a buyer can pretty much dictate his terms, and he'll just, if he's happy to pay the odds, then he's happy to pay the odds. Doesn't mean the rest of the properties in that suburb are worth that amount or have gone up by that amount. It's just that one particular person point in time. So for us, it is a real tug of war going on right now, because we have cost of living pressures, interest rates, but then we also have supply, which is sort of keeping the market there. So it tells us we're not going to see a collapse in the property market, but what it tells us is what's going to occur over the next, sort of 3 to 6 months with that inventory levels. Is it going to start to pick up as the cost of living and interest rate increases start to bite in, and people start to run out and grab their parachutes? So I think it's a matter of we're not panicking. We're just saying to clients, watch this space. It's going to really come back to how the average punter can absorb the cost of living and the interest rate increases. By doing that, what we're going to start to see is a real picture forming of what the property market's going to look like in the next 1, 2, and 3 years. It's a very real case that property may just slowly grind down and just flatline for the next 3 to 5 years. It's going to depend on interest rates. And now with rate rises still on the cards and rate reductions off the cards for the foreseeable future, property is one of those sectors that requires cheap capital. Obviously, not many people walk around buying property with cash. So at that level, that's the biggest problem we have right now. Okay, so this is the other problem that you've got in the property market, and credit growth. As I said before, we've got those scenarios where both owner-occupier, investor and business loans are down. And that's a combination of a couple of things. Obviously, the cost of capital is going up, but also too, expenses are going up and people are borrowing less. If you look at interest rates that have gone from, say, 2 to 5%, if you were buying $1 million property, or you had a capacity to borrow up to $1 million or buy $1 million for a mortgage, that's now been reduced down to $600,000 and $700,000. So the same person 12 months ago could buy a far more expensive property than they can now. So, that's where we're going to start to see things moderate. Banks are getting really tough. Instead of saying, do you eat a Snickers bar, they're asking, do you eat a 1-pack or a 2-pack? And banks are really finding it difficult in this market, and I'll explain why shortly. This is that mortgage cliff that everyone's seen in the press. And this is an example from the CBA. So what we're seeing on the chart here is a percentage of the total amount of CBA fixed rate home loans that are converting to variable over the next sort of 4 years. So as we can see there, up until June this year, about 21% of fixed rate loans are converting over, and then from June to December, about 25% are converting over. So there's still this boogeyman that everyone was nervous about hasn't even shown up yet. We're still going through that process. And then when you overlay that with rates still rising, and obviously the banks have still got a couple of months to pass through all the remaining rate rises, that's why I keep saying to clients, Australian spring will see the true colour of everyone's money. To me, numbers don't lie. There's agendas. You'll see politicians and market commentators and all those sort of things in the background. They'll have their things to say. Mitch and I, we don't benefit if all the people on this call, 200 other people on this call, go out and buy property or not. It's not an issue for us. So from that situation, we're saying to clients, we need to just be careful. People are saying, is now the time to buy? The answer is, it depends. If you're repatriating back to Australia and need a place for your family, well then, yeah, you still need to house them somewhere. But if you are looking at purely from an investment thesis, then you just need to be a bit more careful than you were, say, 2 years ago when everyone was very cavalier. Those who've been on the call before would know that often we use there's a chart from the Australian Bureau of Stats that talks about bad and doubtful debts, non-performing loans and those sort of things. Of late, the banks have been quite creative in terms of adjusting the numbers, as they love to do. So normally what would happen is when we see a 30, 60, 90-day default, the bank would report that to APRA, the Australian Prudential Regulatory Authority, and they would then in turn report that data to the Australian Bureau of Statistics. Where we are right now is they're not doing that. And the reason being is because they're moving the client to the remediation department and in the conciliation department. There's all these departments the banks have set up. And by doing that, it means that they're not reporting an official default because they're trying to manage the client out of the situation. So if you actually look at the ABS stats, mortgage defaults haven't changed much. So in that case, you need to then look at other sources to get a true picture. And to us, this residential mortgage-backed securities, which is virtually how the RAMs and the Aussie Home Loans and those sort of guys and girls operated, where they would lend out money, package it together and sell those mortgages as an asset, which for those who've been around since the GFC would recognise exactly what those are, CDOs and those sort of things. We've got two categories here of RMBSs. We've got prime, which is your big banks, your major banks, and then non-prime. Your prime banks, your sort of blue chip ones, so the top four plus the St George's and the Heritage and all that sort of stuff. Then for the folks who don't qualify for those banks, they can go through loans through subprime or non-prime banks, and that's like the Latitudes of the world, and everyone's probably heard of a couple of others as well too. Because you don't qualify for the major banks, that might be a good reason, might be self-employed and don't have enough history, or you might have a bad credit history. They tend to be more susceptible to rate changes. And as we can see here, when we do look at the non-bank prime and non-prime loans, the non-bank loans are more sensitive to interest rate changes, and by that I mean they're acting early. If you look at the solid lines are the prime banks. So that's your major banks, and then the dotted lines are your non-prime banks. So it's almost like these clients or customers of the non-prime banks are more sort of like the canary in the coal mine sort of thing. They're setting the alarms off that they're having a lot of difficulties in doing that. The prime bank loans, because they've been assessed more rigorously, haven't turned yet, but that's not to say they won't. Bearing in mind we're only 8 rate rises into the 11 that the banks have passed through. So we need to see more data. We need to see at an aggregate level what's going on, because if the non-prime is a precursor to the prime rising, then we know we have a bigger problem at hand. So when we look at mortgage rates, it's certainly, I know, monopolising Mitch's time and my time with clients right now. We've got a lot of clients, their mortgages are resetting from fixed to variable. when we show this chart here, so just ignore the reference rate, that's a bit of a nonsense rate. So what you want to be looking at is outstanding loan rates versus new loan rates. The new loan rates are what banks are offering to new customers, and the outstanding loan rates is what they're offering to existing customers. If you are moving from a fixed to a variable and they're offering you the higher end of that variable rate, pick up the phone to your bank and demand that you want the new loan offer. And if you don't move, if they don't offer it, you'll move. The mortgage market is incredibly tight, probably the tightest I've ever seen it in my 27 years. And so much so that when you see banks pulling offers like the $2,000 rebate on fees and those sort of things, that's how price sensitive they are when it comes to making these deals work. So the cheapest client to get is an existing client and retain that. So jump on the phone, have a chat to your bank. If the bank won't budge, then have a chat to a mortgage broker. This is the QR code for our colleague Jeremy Harper, who runs Atlas Mortgages. Jeremy talks to 30 banks on a daily basis. He knows which banks are friendly to expats. He's a former expat himself, and he navigates all our clients through this real technical maze. So don't just accept a high rate for the sake of it. If you're an expat, that's no excuse. Make sure you take control, because even a 0.25 or a 0.5% variance in your rate can make a huge difference on a monthly cash flow basis. Okay, so running through equities, and this is always an interesting one to talk about, because when we see volatility, people immediately assume equities, and it's actually not the case, believe it or not. So if we look at property versus equities over the last 12 months, equities has vastly outperformed over property, and that's the whole idea behind having diversified portfolios. That's why we recommend property and shares in clients' portfolios, for that basic reason. You get that buffer effect on those two. So let's jump into equities and run through here. People are saying, where do I look? What investments do I consider? And we always say, look ahead of the environment, look out 12 months, determine what's going on, determine where things are going, and make your investment decisions based on that. So what we always say to clients at the moment, we actually had an investment committee recently, and it was reaffirmed at that meeting. We are only interested in price makers and not price takers. So price makers are able to adjust their prices to counter inflation and pass on that increased cost down the line. Price takers, they're the ones who pay the final price, and they don't have that capacity to be able to navigate in an inflationary environment. Classic case in point, the building industry. There's a reason why we're seeing builders going bust, and it's threefold. First one is rising labour costs and also rising supply costs, pieces of timber going through the roof. Second one is when we're seeing a lot of builders who are entered into fixed price contracts, yet their costs of providing that construction has gone through the roof. And last of all, banks aren't going through the mortgages. Once we're seeing a lot of properties not meeting settlement, because by the time these buildings are being built, whether it's an apartment or a house, the market's moved, and the person got assessed on that rate at that point in time. 12 months later, the property values come back, and the bank's saying, well, you need to chip in an extra $100,000 or $50,000, whatever that is. So it leaves that builder and that construction company out in the woods. Avoid sectors that are more sensitive to changes in interest rates. Consumer discretionary. Consumer discretionary is things that consumers don't have to spend money on, but they would like to. So obviously luxury goods, cars, and all those sort of things. Real estate, we said before. Look to sectors that perform well in high interest rate environments. Believe it or not, there's quite a few that do that. And obviously energy, healthcare, utilities, 100 years of chronological data proving that how these sectors perform in each of those different environments. And on this next chart here, you can see that this is a performance chart for sectors 1 year after the rate rise cycle has started. And as you can see there, energy, information technology, financials, healthcare, communication, and utilities are the leading bunch. I will put a caveat on financials. Right now, financials in general does well, but banks aren't doing very well at all. And the reason being is their net interest margin, which is their profitability, is at record lows. And like I said before, when they start pulling back deals or offering $2,000 here and $3,000 there to refinance, things are very, very tight. Other companies inside the financial category that do very well in rising rate environments are insurance companies. And the reason being is they take your premium, they invest that money in bonds, cash, equities, and then they hope you don't claim, but if you do, they've generated a return from those premiums to cover the cost of those claims. So insurance companies do very poorly during times of low rates, and they actually do quite well in times of higher rates. Sectors that do it difficult in a higher rate environment: industrials, less so; consumer staples, less so. That's your Coles and Woolworths. Materials, that's a GICS change. It's actually resources, but they call it materials. So your BHP, Rio, and those sort of things. Though obviously what's happening with BHP and Rio at the moment would probably moot those points. Consumer discretionary, 100%, and real estate as well. So when we look at the Australian banks, this is that net interest margin I referred to before. And essentially think of that 1.9% that the chart shows is the difference between what they're borrowing the money at and what they're lending it out to you at. That's all they're making, 1.9% on that mortgage. So the banks are getting really, really tight. Our biggest concern in that sector is if you're, say, investing in a ASX 200 blanket ETF. Now, 38.5% of that ETF are the Australian banks. So be very careful in that area, because there's a very real chance that almost 40% of your portfolio could act as a handbrake or an anchor on the performance of, say, the energy, the health, the tech that is doing very well in this environment, because the banks are such a large part of the ASX index. It's a major concern. Not so much a concern in an S&P 500 or a FTSE 100, because banks are about 15% of the index, and it's a more palatable weighting accordingly. And last of all, when you're managing equities, reviews are very important. And the reason I say that is, yes, I've said energy is the best performing sector in a high rate environment. However, just because it's done very well, and the energy sector has done very well over the last 12 months, you need to always keep a weathered eye in terms of what's coming down the track. And it may not always be economic. So what I've put here is the Albanese government are looking at making changes in terms of a price cap on gas. And it is going to sort of adversely affect the gas market. So as an example, in our investment committee, we're actually reducing and removing some gas providers as well too, because one thing we hate to see is the federal government getting involved in businesses running businesses. So your papers are your best thing, internet, those sort of things. You can see what's coming down the line, where those confusions are, where those concerns are. You don't have to be a day trader, and I'd highly recommend you don't be, but certainly just take a pragmatic approach to managing your portfolio. Once a week, just run your eye over the papers and see what the narrative and the conversations are going, because it does change like the wind. And to me, especially when we have a government that is highly geared in debt, both state and federally, you're going to start to see some pretty rash decisions coming out over the next 1 or 2 years, and that's how they're going to try and pay down that debt. So let's run on to the bonds and the fixed interest market, which is not a market that a lot of Aussies know about, but it's a market that a lot of Aussies should know about, because historically it's always a great market that enables investors to build like a shock absorber into their portfolio from a diversification point of view. You're never going to make as much in a high bond market as you would make in a high equities market, but also you're not going to have it on the downside as well too. And these things tend to work in a concentric cycle. So bonds and fixed interest are a big thing that at the right time, they're a very effective tool. At the moment, we're not very bullish on bonds. And the reason behind that is this chart here. So a lot of the central banks around the world, including the RBA, bought a lot of bonds through the COVID period to try and prop things up. Now, central banks aren't investors. However, if you look at the, I think it's the grey, if anyone wants to jump in the questions column and correct me, go for it. But as you can see here in the grey space between these areas here, just go back here. You can see here, that's a normal amount of bond holdings that the RBA has. And then we get into 2021, 22, and look at the size of that, and then 19, 20, then 21, 22. So now what has to happen is the central banks have to roll these out. They have to sell them down. And by doing that means they're going to sell into strength and sometimes sell into weakness as well. So that's got to put a cap on bond markets for, certainly the short term anyway. When you've got an elephant in the room the size of the RBA selling, it's always going to put downward pressure on the on that performance. And this chart here, which is the US equities versus US government bonds, really personifies 2022. So as we saw there, 2022 US equities was down about 18%. Now that should have correlated with about a 6 to 8% gain in bonds, but it didn't. Bonds were down 12%. And the reason being is the central banks are in there selling. So until that selling abates, I think, it's a market to be looked at carefully. Be very, very careful. People don't realise you can actually lose money in bonds. You can actually lose capital in bonds. You can lose, you can buy something at 102 and it be worth $98, and suddenly you're making a 3 to 5% coupon on your bond, but you've just lost $4 on the price, which is 4%. So bonds are very, you need to be very careful with bonds, especially in this current market right now, because the rule book has sort of been thrown out for the short term while people are managing COVID. So on to commodities versus bonds versus equities, and this is what I was saying before. Normally you get those bonds, so that grey line should have been sitting about 6 to 8%, but as you can see, it wasn't. Last year was a tough year for the bond market. Expected year for with equities with respect to rising interest rates and also to the invasion of Ukraine. But as you can see, commodities did very well, and that's once again the whole importance of having a balanced portfolio. So I'll just quickly run through on the currency side, guys. So we're going to talk about Aussie, US, Euros and Yens. Look, Australia to me is back to its natural state. 66 to 70 cents is its happy level. Two things primarily drive the Australian dollar: interest rates and commodity prices. Commodity prices are starting to settle down, so now it's primarily interest rates. If we do see Jerome Powell get his way and raise rates in the US, but the RBA decides not to raise rates, then we're going to start to see the Australian dollar underperforming against the US dollar. So obviously next month is a pivotal month from my point of view, because you've got the FOMC meeting. FOMC is saying, they're not going to raise rates in the US. Jay Powell, who's the chairman, is saying they are. And then you've also got the Philip Lowe with the RBA. So that will pretty much dictate what's going to happen going forward. To me, with interest rates, it's going to be a bit disjointed in Australia. And the reason being is Philip Lowe's contract's up for renewal very shortly. Given his public persona, I don't think he's got a very good chance of having that renewed. So the question is he going to be wanting raising rates up until the date of departure, or does he want the new RBA governor to have to raise rates immediately? So he may try and front load interest rate rises now to then give them that gap while we have that transition period. So it's going to be an interesting one to watch. On the Aussie side, I said US Fed and RBA, they're working in lockstep. So what that means is that's why you haven't seen the Australian dollar change much. But if we do see an outlier event, one raises, one doesn't, then that's when you're going to start to see things kick off. Obviously, any signal suggesting a peak in Fed funds rates could help and assist the Australian dollar, because don't forget our official cash rate is below theirs, when historically it's always been pretty close on that. So watch this space. On the US dollar, as I said, Jay Powell, it's a big one about who's right. Is he right, or is the FOMC right? So early June, we're going to know unequivocally whether they're raising rates again, and that will certainly set the tone both for the currency but also to the equity markets. On the Euro side, we've seen the ECB talking about further rate hikes as well, as the RBA, as Jerome Powell is. So we're not finished just yet. If it was one or two central banks, I get it. But to me, it's not. It's actually all the central banks, the major central banks around the world doing it. On the pound, strong start. Pound's been a great performance since the disaster of August that everyone went through. And, certainly it's been doing very well in the middle part of this year. But in saying that, it'll depend on the ECB, Bank of England. So Bank of England raised rates last week. Will they continue to raise rates lockstep with all the other central banks? That's going to be a wait-and-see approach. So I think we'll quickly roll it over to the Q&A section there, Mitch. So let me just grab a glass of water and we can start heading into this. So, okay, so first question is from John. So TR2022/D2 is still the current document? Yes. John, so what John's referring to is the draft ruling that the ATO handed out in 6th of October, I think it was. So long story short, that's the latest one we're working from. That's the gospel until we see otherwise from Canberra. That's what everyone should be referring to. We actually did Ben Turner did actually a good article on that early this year, I think January or February anyway. So have a look at that, and yeah, if you have any questions, reach out to us. Another question here from Rachel. I'll let you handle this one, Mitch. So when they do make a change to the tax residency rules, what sort of time frame can we expect before implementation? Is it possible it will be imposed or applied in retrospect?
Yeah, it's a really good question, and you know, you'd hope they'd give, you know, Aussie expats enough time just to sort of plan for what those changes might mean for them. But you know, if anything, like if we have any sort of change in legislation that we can use as a reference, it might be the main residence exemption. So that was something that was, I think, mentioned in 2017, or it was mentioned in 2017, and then it was announced that it would be implemented in the 2019 budget, and then it came into effect in 2020. So I mean, you and I, when we have discussions about this, we sort of always think about the main residence exemption. No one, you know, you and I didn't think that would sort of be implemented as quick as it did. So, you know, we hope that that, you know, Australian expats would have enough time to sort of plan for it, but we're probably looking at, you know, at least minimum 12 months, I would say. And it's likely it'd come into effect from you know, the beginning of a financial year as well.
There's a lot of water that goes under the bridge when legislation's passed. So to explain to folks, what happens is they announce it. They then release what we call the explanatory memorandum, which explains the legislation. It goes to the scrutineers committee to make sure it's a proper piece of legislation. Then it goes to the lower house to be voted. Then it goes to the upper house to be voted, and then it gets royal assent. The quickest I've seen a big piece of legislation rushed was MRE legislation in the second half of 2019. So normally, in a good day for Canberra, you know, it's going to take them 6 months at least to pass it through I guess the different hands in Canberra. But then they can't make it retrospective because people have been acting on, you know, the letter of the law up to that point, whatever's legislated. So normally it comes in, you know, in the following tax year. So let's say, for example, you know, let's run through a scenario. If they announce today that they're going to change the, you know, non-residency rules, well then we'll probably see an explanatory memorandum July, August. It'll go through lower house, it'll go through upper house. It wouldn't probably more than likely come in until 1 July 2024. And then from that date onwards, that's when it'll run from. So we've still got a bit more time left there from your point of view, Rachel, so don't be too worried about it. Will it be retrospective? They've always insisted they don't. MRE was definitely a retrospective, you know, change, but they're still insistent it wasn't. But with this sort of thing, people can't make decisions based on hypotheticals and possibles and probables.
Yeah, agreed.
Okay.
Agreed.
Okay, so the next question from Andrew. How much of that increased consumption is due just to increased costs? Is it a true increase in consumption or increase in cost of consumption? I think it's a bit of both. What do you reckon, Mitch?
I'm just wondering which slide Andrew might be referring to.
I think he's looking at that consumption chart. I think it's this one here. I'll just see if I can find it. And certainly correct us if we're wrong, Andrew. Where are we here? I think it might be this one here. So that consumption chart. So that's the only one we've put up so far. So let me just go back here.
Oh, the household income and consumption.
Yeah. That one there. So yeah, Andrew, correct us if we're wrong, but certainly, you know, look, to me, yep, that's the one he said. Thanks, guys. To me, it's a combination of both. You know, the feeling I get is the consumer feels like they're entitled to more. They're entitled to a better lifestyle. It's all about me. It's all about, you know, having a best life. So when they spend more, I mean, as you can see, even before COVID, our consumption levels were down, in sort of the 1% and 2%. Even now on an adjusted basis, we're still sitting at, close to 6% there. So the consumer, even now, given all these changes, it's still consuming a lot more than they were pre-COVID. So when we look at that sort of factor, it does come into play. So I think it's a combination of increased costs and increased consumption.
Yeah, agreed. The whole, economies is sort of built on consumption, and I think an increase in cost would be attributable to those figures that we see there for sure.
When you look at people's behaviours now, people used to go into a one-bedroom flat and then they'd drive a Holden Camira and then they'd trade up, better place, better car. These days people are coming straight into a four-bedroom house and driving some pretty flash cars. So I think the consumer's certainly changed, that's for sure.
Yeah, I agree, 100%.
Next question from Ron. Being an expat in the UAE, investing in ASX, what are the tax compliances? Any possibility of ASX ETS with drip option to avoid tax? How about I'll jump onto that one, Mitch, and then I'll let you come in at the end as well too, just because I'm based in the UAE now, I can sort of address that pretty succinctly. Sure. When you're an Australian tax resident, property and shares are both treated as taxable assets. When you do come out of Australia and become a non-resident, assets split. So you have taxable Australian property, house, apartment, block of land, and then you have non-taxable assets, shares, managed funds and ETFs and those sort of things. What happens is, as a non-taxable asset, it means that you can have an account in Australia, you can invest in Australia, as well as invest overseas from Australia, using Australia as the domiciled account. But as it's a non-taxable asset, you don't accrue a capital gains tax liability. The only tax issue you need to take into account is obviously what we call non-resident withholding tax. So non-resident withholding tax is either 15% or 30% that's withheld from the dividend before it's paid, determined based on the country you reside in. If you reside in a country with a double taxation agreement, 15% is withheld. So if there's a $100 dividend, you get paid 85. If it's a $100 dividend and you reside in a country that doesn't have a DTA, then you get 30% deducted, so you get $70. However, the benefit of that, it's more so an added bonus is the fact that Australia runs a system called the franking credit system. And franking credits is company tax paid on the behalf of shareholders. So let's say BHP makes $1 billion profit. I know they make a lot more, but let's run on simple numbers. They make $1 billion profit. They pay $300 million of that to the ATO, which leaves them $700 million left over to pass on to shareholders by way of a dividend. When that dividend passes through to shareholders, the ATO really can't tax it again because that pool of money has already been taxed once. So tax has been paid on your behalf at a rate of 30%. So what that means is if you are eligible or have to pay 30% non-resident withholding tax and there's a 30% franking credit attached to that, those two net off together. So from that point of view, you can extinguish most of your income. If you are investing overseas from Australia, obviously there is no franking credits available overseas, but it doesn't tend to worry us too much because if you invested through, say, interactive brokers, they're going to take non-resident withholding tax of 30% anyway, and overseas yields are quite small. For us, the tax issue is not the issue. From a compliance issue, that's a different story. ComSec, CMC, ANZ Stockbroking, NAB, they've all put a ban on expats, and that comes back to the common reporting standard. It comes back to they don't want to have the headache of dealing with the extra compliance of dealing with expats. And they just say, no, see you later. As soon as you ring up and do the right thing and change your address to a UAE address, they'll freeze your account, cancel your CHESS in and send you out issue responsive statements, which is a nightmare for expats because especially in Dubai, we don't have mail. So I don't know how they expect us to get those blue forms from the registries, but we never get them. And then you have to go cap in hand on the phone to the registries to find out all your SRN numbers. So it is a nightmare if you try and be clever. We see people who have a ComSec account but they use a family member's address. The problem with that is your account's not properly categorized as a non-resident account. Therefore, they're not withholding the non-resident withholding tax. Now, it might only be 10 or 20 bucks, but if you've got outstanding returns or you're lodging a return that says you don't owe anything, technically you owe them 10 to 20 bucks. And we've seen clients have to pay thousands of dollars to go back and refile 5 years worth of returns, all for the sake of 150 bucks. So, Mitch, you got anything to add on that as well?
Yeah, Ron, not too much to add to what Brett just said there. I think, the best approach to compliance to compliance when investing in Australia is, just making sure that your tax residency and your overseas address is flagged with whichever Australian platform you're using and you're holding your shares through. But yeah, as Brett alluded to, there's some brokerage platforms that don't allow non-residents. So I'll just caveat with that. So just be careful of that. If you sometimes think twice before you go and update your tax residency status or your address with these share brokerage platforms, because they might look to move you along to a different brokerage provider. So just be careful at the same time.
Yeah, they're a discount brokerage for a reason, which means their profit margins are very low. Because they're low, they don't want any extra expenses with respect to the compliance side. One other question that Ron's actually highlighted was DRPs, dividend reinvestment plans. It doesn't really solve the problem, Ron, with respect to non-resident withholding tax. If you reside in, I think, the UAE, as he said, that'll be 30% withholding tax deducted if there's no franking credit, which means that when your shares are reinvested as part of the DRP, it just means that 70 bucks instead of 100 bucks will be invested. So DRPs don't really get around it. DRPs are more so just from a convenience point of view. Question from Julianne Vanderlinden. So what platform can non-residents use to invest in ASX if most don't allow it? Good question, and it's something that is a constantly evolving beast. We're always seeing updates from these providers. It's a funny one where it's an internal decision. So we'll have a list locked down and then we'll try and do something with the client and then find out a week before that their compliance department decide to change. So pretty much expect all the big ones not to do it. Sort of almost like the big four banks who don't want to do expat loans anymore. They're just getting very, very myopic when it comes to who their client base is. So we do have 4 platforms we use, and those 4 platforms we use will be different from different clients in different jurisdictions. Some platforms don't allow clients in Europe because of GDPR. Other clients don't allow people in the Middle East because of the FATF grey list. It's an evolving piece. It really is changing. So, Julianne, it will depend on your jurisdiction. It will depend on a lot of circumstances as to if we were to engage us, what we'd recommend you invest on. We get a bit of flexibility that they afford to us because we put clients through quite a lengthy onboarding process from an anti-money laundering and counter-terrorism financing point of view. What it means is it really comes back to asserting that you are Julianne and you're from here. You're not Fatima sitting in Kabul funding the Taliban. So we do video calls, we record those video calls with the compliance officer sign off, look for digital trails, look for source of wealth. There's a lot more stuff goes into it as opposed to just picking up your phone and setting up an account on ComSec. And that's one of the reasons ComSec's not designed for that and they can't handle with that. So question from Rosie. Do you have any brokerage platforms you recommend in Australia that are accommodating to Australian expats, or would you suggest instead just one to local where we're based, Singapore? Mitch, do you want to have a crack at that one?
Yeah, sure. So I mean, can't sort of recommend products per se, without having a conversation with you and understanding your circumstances. I think,
just explain to the folks, it's not us being cagey, it's from a legal perspective. Everyone's ASIC wants us to go through all the hoops and all those sort of things that suitability tests and all sorts of stuff. So it's not us, trust me, we hate red tape.
Yeah, exactly. And I mean, there's very few. I would say that there's very few. I mean, Brett, you mentioned interactive brokers before. I think they have been a little bit friendlier and sympathetic to Australian expats historically, but their rules can, their onboarding processes can change it as well. So I could say they're open to Australian expats, but tomorrow they could have a different process in place. So it's very much an evolving piece, as Brett suggested. But
and people need to look at.
It's limited.
Yeah, people need to also consider too. Just because you invest internationally, and you may have never been to the States and never planning to go to the States, if you are investing in a US domiciled account or a US domiciled asset, it does subject you to US estate planning tax. And a lot of folks don't know it. We in the UAE here are talking about with clients all the time. And we say, just because you've never been there doesn't mean there's no taxes. And what happens is, let's say, for example, you've got a husband and wife with an Interactive Brokers account, domiciled in the US and holding US domiciled ETFs. Something happens to the husband. Normally what would happen in Australia is the wife would inherit the shares by way of survivorship, and from an account perspective, just things continue on. In the US, not the case. So what will happen in the US is Uncle Sam thinks he's entitled to 30% of that balance, and he'll take that money, and then the surviving beneficiary will then receive 70%. So Interactive Brokers, it's a beast of a system, but you need to understand US tax complications and also to understand how to use it. It's not something that someone new to investing would be suitable. There's also Saxo Bank. There's also quite a few other ones. But once again, when we follow the trail, quite often we come back to that US domiciled issue. So you do need to be very, very careful of it. So answer to Rosie, certainly you can do it in Australia. You have to go through a few compliance hoops. If you do want to do Singapore, just be careful of that domicile effect on those accounts. And a question here from Scott. He says, what are the 4 platforms you're recommending? Scott, unfortunately, we don't know your circumstances, so legally we can't tell you to go this, and this. Since 2018, the Banking Royal Commission compliance has gone through the roof, and certainly been a bugbear of our situation. Canberra's happy because everything's tightened up a lot, but what it's actually done now, it's put the red tape in a crazy way that unless we know your favourite colour and the name of your dog, legally we can't actually advise you on what the best platform for you is. Okay, any other questions there, guys? I think we've answered all of those ones there. Righto, folks. Well, I think we might wrap it up there. So thank you very much for your time and attention today. We'll also be emailing out a copy of the recording. So even if you're on live, you'll get a copy as well, along with the slides. For those who are watching the recording, feel free to email us. I'll just put up on the end here how you get hold of us. So if you want to book in a call for us, if you want to find out what the 4 platforms are, feel free to book in a call. That goes through to our contact page, and then either the Australian office or Dubai office will look forward to helping you. If you want to follow us on the social media channels, we're very active on those areas too. So certainly non-residency tax rules and all these moving parts, that's how we broadcast most of that information. So jump on the socials, on Facebook, Instagram, LinkedIn and Twitter. Guys, thank you very much for your time. It's been a pleasure talking to you guys this morning or this afternoon or this evening. Mitch, thank you very much for your time. It's almost bedtime for you, so I'll let you go to enjoy your evening. And remember, folks, we'll get a message out about the next webinar, which is with Ben Turner in early June. So thank you very much for your time, and we'll see you on the next webinar.
Thanks, everyone. Bye.